Marabella, Net Lease TV. We're covering Fed Chair Powell's interest rate decision here. It's Wednesday, December 13th. We've got about 10 minutes until the presentation starts. Just a couple things. CPI was up 3.1% in November. That was a slowdown from October. Prices from the previous month were up 0.1%. Federal funds rate is still 5.25%, 5.5%. 10-year Treasury today is right around 4.16%, and that's down from 5% in mid-October. There's one of our graphs that we looked at. There seems to be a lag between the 10-year Treasury yield and the federal funds rate. So we'll put that up on our screen at some point. And Yellen is predicting a soft landing. The higher rates have been a burden on the fiscal situation, the federal government budget, and Yellen's saying possibly that Social Security and Medicare costs could go up. One of the big factors with the inflation has been housing prices. Here, we're on that in San Diego. The prices have gone up dramatically. There's really no supply of houses due to regulation, no land, disruption in the supply chain, and not many construction workers. So that'll be interesting to see what happens to housing prices. But for the last 2 years in the San Diego area, houses have gone up dramatically, and there's no supply of houses for sale. So we'll see what happens with that. Nice thing, smoother supply chains, more restraining consumers have lowered the prices on cars, electronics, TVs, appliances, washing machines. Hasbro came out yesterday, was in the Wall Street Journal. They're going to be cutting back employees. So not a great Santa Claus year for kids of the millennials, because their parents aren't buying as many toys this year, and Hasbro is laying people off per the Wall Street Journal. Another thing that's kind of alleviating inflation is the price of crude oil. Crude oil today is right around $68.85. That's down from $93 in late September. Probably has something to do with the election. We're about less than a year out before the election in November. So probably the Democrats, Biden's trying to get the economy up, and he's somehow got the supply of oil increased, and the price has been coming down right around $68.85 today, down from $93 late September. So Trump keeps saying if he's elected, he's definitely going to be more bullish on oil and gas, which would be good for inflation, as well as the Republicans. So we'll see what happens. All right, let's listen to Jerome Powell.
And the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal.
Again, trying to hit 2%.
Restoring price
That's his
stability
goal.
Is essential to achieve a sustained period of strong labor market conditions that benefit all.
And again, it's been impacting the
Since early last year, the FOMC
the
has
burden on the
significantly
federal
tightened
government
monetary
as far
policy.
as
We've raised our
interest
policy
rate, more
by
interest
5.25
rate costs.
percentage points, and have continued to
And
reduce
Yellen's
our
saying more
securities
Social
holdings
Security
at a
and
brisk
Medicare
pace.
cost increases. So that
Our actions have moved our policy rate
Fed
well
is
into
helping the
restrictive
government at
territory,
the end of the day.
meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt.
Hopefully they'll get looser,
Today, we decided
because
to leave our
it
policy
definitely is
interest rate
affecting
unchanged and to continue to
the
reduce our
liquidity
securities.
of banks and lending on net
Given
lease
how far we have
properties.
come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
Built Central is an awesome new technology where you can research and find out what developers are building what, where, and when, right? Information is the main thing with our business. Information can make you a lot of money.
In the commercial real estate business, finding and tracking planned retail developments can be difficult and time-consuming. News articles often miss sufficient location details, and many planning documents lack adequate contact information. This frustrating research is done every day, and often information is gathered on the market of the moment, and the data is not kept up to date nor shared organization-wide. Meet Planned Retail. As the nation's leading construction data provider, Build Central solves these problems by providing best-in-class retail construction data. From planning to completion, our data tracks the entire development process and provides key contacts along the way. Build Central's construction intelligence pairs human data curation with proprietary search algorithms to identify projects well before permits are even submitted. The future of retail is only a click away. Contact us today to get started.
I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions.
Although housing supply chains are still lacking.
Activity in the housing sector has flattened out and remains well below,
which has been good for prices. Prices in San Diego are just going up tremendously.
Higher interest rates also appear to be weighing on business fixed investment.
But for commercial real estate, there's not as many buildings, net lease buildings that we want due to the supply chain issues as well.
With the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%.
Still, again, they're still trying to stick with their 2% mandate.
Prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion.
So they're doing the tapering, and that's really caused a taper tantrum in the economy.
And inflation.
Early coming out of the credit crisis 2010 and 11, the Fed was buying the CMBS paper, artificially lowering the interest rates
of significantly reducing
and buying bonds, and now they're selling those bonds, which is causing a taper tantrum in the economy.
The economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of
you got the 10-year treasury still right around 419.
Sustainably down.
Dow Jones Industrial 36,577.
Inflation is on a path.
Looks like it's up 173 points right now.
FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table.
So they're going to keep rates steady at the 5.25%, 5.5%.
That the appropriate level
federal funds rates, it's kind of a Goldilocks situation, not too hot, not too cold.
3.6% at the end of 2025 and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our.
So it sounds like they're going to be lowering the federal funds rate.
In light of the uncertainties and risks,
which makes sense with our graph.
The committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook.
Although they're probably going to be looking at fiscal policy
in determining the extent of any additional policy firming that may
to see if the government is going to be raising taxes.
The committee will take into account the cumulative tightening of monetary policy
in the future, which could have a negative impact on interest rates and the economy. Or actually positive, it would lower interest rates and the economy would go down if taxes are raised.
Longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, let's listen in on some quick questions here.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle.
Okay, well, they're saying that maybe we're at the peak rate cycle. So that's good news. It's probably
that's what we wrote down.
Downhill from here, which is great. We'll be coasting downhill, hopefully. Should help banks.
That's really what we were thinking.
With their lending and make the economy a little more stimulated here in the near future.
Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question,
you definitely did. The rates shot up federal
really,
funds rate went
how high
up
to raise the policy
dramatically.
rate.
I think it
And
was
that's really the question that we're still on
close
here.
to zero
We're
right
very
around
focused on that. As I
the
mentioned,
pandemic time, or a
people
little bit
generally
past that.
think that we're at
But I'll
near
bring
it,
up a graph on that
and
so you
think
can
it's
see
not
that.
likely that we will hike, although they don't take that possibility off the table. So that's when you
So
get to that
unlikely they're
question,
going to
and that's
hike,
your
but they
answer,
still could do so.
there's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways
So
to
it
go.
sounds
No
pretty
one is
good.
declaring
It
victory.
seems
That
like
would be
things are,
premature, and we can't be guaranteed.
again,
it's
that
progress. So
Goldilocks,
we're
not
moving
too hot,
carefully
not
in
too
making
cold.
that assessment
That's
of
kind of
whether
what he's
we
saying,
need
I
to do
think,
more or not.
that they're going to monitor it.
That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view. And is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
All right, Jerome Powell, FOMC
Nature of that
meeting,
discussion today.
and
Thank you.
we'll talk to you
Sure.
soon.